All right, all. So a very, very warm welcome to all of you for the India Market Review, the new series for 2016. Very happy New Year to all of you. I hope you had a good start. My year has been, touch wood, good so far in quite a few ways, and I hope it's been the same for you. So we've had a almost 3 month hiatus on the IMRs. Some of you have been missing it, some not so much. That's fine. And what we've been working on basically at the back end is to make it more effective and better than we have had previously. So those of you who have visited the IMRs earlier will probably see a few differences going forward, and I hope you find them useful and insightful, more practical, more actionable. And I would love to have your feedback on these updates and changes, and any changes or additions that you may like to see on the session, because we definitely want to make this year a lot more active, a lot more action, and hopefully a lot more profit than has been happening last couple of years. There are quite a few plans in the pipeline, and you'll see them roll out one by one eventually, right? Okay, so having said that, let me just jump in, and we probably have a few glitches and bugs, so I hope you'll bear with me. Just checking a few things out. So what we want to do today is essentially not a very deep session, but a session where we are basically going to cover all the 50 stocks of the Nifty, plus hopefully all the sector indices, and we'll also probably have a look at some of the global indices and see how those are behaving in the usual format that we've had, top-down analysis. There is also, we now have fundamental data with us, which if we have the time, I will be happy to discuss. So we've got data for dividend yield, for book value, sorry, for price to book value, and for price to earnings ratio. We also have data for EPS, the absolute EPS value, the absolute dividend value, and the absolute book value for a number of indices, Nifty and sector indices. And going forward in the IMRs, I plan to be doing that. That is a completely fresh update. We did not have that automated earlier. We've got that done. And the third thing, which I don't think we'll have time to do today, is we now also have, BIC has data for all the Nifty futures, the futures data. So for all expiries, for the near month, middle month, and for the far month, for all the FNO stocks. So it's a huge database which is now ready for actually quite a lot of useful stuff. And in the, by the way, futures data, we also have open interest data in the charts. I don't know whether we'll have the time to do that today. I think we won't, but just letting you know that this has all been done. So we've got our usual price volume data. We've now got our fundamental data for a large set of indices. So that's a big plus for my perspective. I think some of you know my views on the usefulness and the importance of fundamental data. And we now also have futures data and the futures charts for all the underlyings. So that's what we have, and I hope to cover as much of that as we can today. So with that brief, let me just jump in. Okay, so what I want to do quickly is to take a global review of how the global indices are doing, and then we will come down to India. So this, what you're seeing, is the Dow Jones index, and let's zoom in, right? So very clearly you can see that the Dow Jones has been doing pretty badly. There's no nothing new about it, I'm sure. You can see that the whole of 2015 actually was a huge distribution zone that happened between 17,600 and 18,200. Towards the third quarter of the 2015, the market corrected and it went down, and then we've got this attempt to sort of go back up at this point, but actually quite you know what unsuccessful move as is obvious, and then we've got this big down moves as you can very well see. And well, right now, so this is not a live chart. There is another uh, tool that I have for live charts, so I'm not going to be doing that right now. So you can very clearly see that this is going down, the Dow Jones, and it is going down on higher volume. There's absolutely no need to look at even, I would say, indicators in this case. Very clearly, the trend is down. So this is actually not including today's, this is including yesterday's. And even if the market has corrected and gone up a bit in the earlier part of the day, I think European indices were quite positive. The thing is that it has not actually come down to any support level of substance, and after a big fall like this, as you can see from here, any bounce is something that you want to be a little careful about, because it's not likely that it's going to just very, very quickly go back up, right? So any bounce at this point looks more like what's called a dead cat bounce, and at least on the Dow Jones, we should probably expect lower values at least till 16,000, and then if we go below, who knows, maybe till 15,600 also. So we've had all this global events, and oh, I forgot. So let me bring up a Word document for our So as we know, we usually take a stock of global events and how things are going there. And so you've got the Fed raising rates. You've got apparently low unemployment in the US, and the US economy doing well, right? Uh, that's at least the general opinion. Of course, there are people who are not so sure about this. Now, well, let's assume that's true. I don't want to get into a debate today. I just want to do a lot of things quickly. Then the market's going down. Then the question that you've got to ask is, does the market know something that is not obvious? And is it just because of um, Chinese factors, as we all, as everybody's talking about it? I don't know. But what I am definitely saying, or what at least what the charts are certainly saying, as far as the US is concerned, is you've got a massive top, I think, in place for, the first 6 months of 2015. You've got a fall in the third quarter. You've got an attempt to come back, but now we seem to be going back up, and 15,400. Don't expect too much policy stuff in the US this year, because as we all know, it's US presidential year. So that's, I think, basically it. And probably till the next president gets decided for the US, there's probably not much uh, political or policy driven reasons why the market should go up, and the uncertainty is probably just going to get higher and higher as we go forward, and the markets definitely do not like uncertainty, right? So that is as far as the US is concerned. Let's very quickly look at uh, we've got China, right? So oops, the data is completely conked on this, so I'm just going to have to skip this. We'll look at FTSE. Okay, so the FTSE, well, this is not a very good picture at all. You can see that this has been going up since 2013 here. All right, 2013 is there, and then hasn't really done much in the whole of 2014, and 2015 has also been a very lackluster year. So made a probably a new life high. So let's see if I can get the whole data. Yep, that's the whole data, at least on this database from 2006. So we got a new life high on the FTSE in early 2015. It came down, broke through those very important support levels around 6,800, which is a multi-year support or 2008 top again broke down and came back to the 2011 levels, and we seem to be really dragging around that. And well, looks like by all looks here, we are looking at lower levels at around 5,400 on the FTSE. So definitely not a good picture there on the FTSE either. And very clearly, I think, you saw lower tops, lower bottoms here. Let me just draw that. Is as anybody will know who knows even basic TA. And then we've got a support zone at around 6,000, 5,900. But again, looks like right now any bounce on this is going to just be a dead cat bounce. You've got falls happening on higher volumes, and any up moves that are happening on the FTSE happening on pretty low volume. So that's as far as the FTSE is concerned. And then the biggest one in Europe is of course DAX. So we'll have a look at that. And if Germany also is in not a good shape, and it actually isn't, right? So this is DAX. Uh, Certainly uh, not uh, and clearly you can see the DAX is doing lower tops, lower bottoms. The FTSE was not, but this is clearly doing lower tops, lower bottoms, and 9,400 should be a level that we probably want to watch out for. And the sort of red candles you're saying, pretty strong Marubozu type red candles for a long time, and the good support at around 9,000 or 9,300 at those levels. Right now the DAX is at around 9,800. So we're talking about at least a 5% correction further, which is possible on the DAX. And in my opinion, really good support is only around 8,000 levels on the DAX. So whichever way we want to look at it, things are not really looking good. And lastly, let's look at Japan. Okay, and if you look at the Japanese index, which has actually been doing extremely well. So some of you who have been in the IMR last year, or who've been in the mentorship program and we've been discussing about it, or did EQNS in 2012, 2013, we spoke about Abenomics and how that could be advantageous. And well, just to point out, from 2013, when the Nikkei was at 9,000, it went all the way to 20,000 plus, and now it is clearly correcting. And the correction is not actually minor one. You've got a pretty clear top there. And why did this happen? All right, some data somewhere. Okay, so you can see more or less a similar picture. This part where the cursor is all 2015, and just like the Dow Jones has gone up, came down, and then has gone up and has just not been able to hold up there, and it is clearly coming down. There may be a potential inverted hammer here and the last candle. It's a daily candle that we are looking at, but we'll need a lot more confirmation before you can say that this trend is going to change. There was talk by the central bank of Japan that they will take additional measures to pump in liquidity into the market to support the market, but seems to be a pretty long shot right now, right? So, well, I think very clearly overall, if you look at the global equity indices, there's really nothing helpful here at all. And uh, by all across the world, the picture is pretty bleak and bearish, and we should possibly be expecting lower levels. Now, just want to add that there are people who talk about the January effect. Some of you might be aware of it. So the January effect basically says that if January is bad, the year is bad, and if January is good, then the year is good. Well, we are in a sense halfway through January, so let's keep our fingers crossed, because if January doesn't close nicely, of course, we will continue to do IMR starting having that. Now that we've started, we'll know in 2 weeks, but things are not looking good really right now. The other, so let me just make that note. So bearish trends across all global equity indices, right? So that's if Jan closes in the negative, then possibly the rest of the year is also, going to be not so good. So that's something to keep in mind. The other big thing, and I'm sure some of you could possibly know, is that we have had an massive up move, okay, since 2009, right? And without, and this is the important thing, without any meaningful correction, okay, since then. So essentially, we are talking about what, 6-year bull market, okay, uh, with no bear market. So are we looking at a possible bear market? I don't have an answer right now, but this is a question that I think we have to keep in mind. And in case any of you are feeling disappointed about the start of this IMR, and well, it's not the IMR, that's how the market is. And the way I look at it, for those of us who are confident about shorting, then it's a wonderful opportunity. You make much money. You make a lot more money much faster when you short, as we all know. And the other thing is that uh, if you are long, well, then perhaps this is a good what would I say, advance warning about possibly lower levels, and you want to be prepared for that. And the third most important thing, I think, is to be ready sitting on cash as and when the markets do bottom out, and this could take weeks or months, to be able to get in and then make some really much better uh, investments at lower levels. So let's see. Okay, so that was the global view, and with that, let's jump into the India scenario and see how the India market is panning out. Let's see if I hope this is all working fine. Says default chart. Okay, just give me a second. Okay, so what we have here and what you should be able to see on your screen is the Nifty chart updated till today. Okay, and this is the same format as has been there before, but you're going to see some changes in a few minutes. So what we have here is a simple candlestick Nifty chart, and today morning was a bit of a chilling effect, as all of us know, when the market broke 7,600 in a pretty decisive manner and went to even a low of what is the low today? 7494. So it had broken 75 also, and there are a lot of questions about what's going on and are we going to fall, etc., etc., etc. So let's look at the big picture. Let me just yeah, so that's the big picture of the Nifty right from, well, 1996 to long. So let's zoom in a bit. So essentially, what you should be able to see right now is from the time of 2008, and then the 2008-9 crash, and then the move up. And as you can see, so from 2009 onwards till till the present move, really not much of a huge crash, nothing like a bear market. Somebody might say that this is one. Okay, and well, if you want to say that, I really can't argue about it, because that's a move down from around 6.5 till 4.5. That's definitely substantial. And then we have a move that's going now down from 9,000 to about 7,500. So that's about you know 1,500 points, but on the overall it's about 15%. So more like a correction. So not a bear market as such. We've not seen a bear cycle. These are all corrections if in a larger bull market possibly. So taking a multi-year view, or even I would say perhaps a multi-decade view, and the market has come down by about 10-15%, which could be considered more correction rather than a full bear market, right? So the question is whether we are going to enter a bear market into 2016 and or vis-a-vis just have a correction right now. Uh, so right now we'd label it as a correction and then we'll just have to see. So, just remember these horizontal support lines that will remain on the screen. And what's so now happened is that we've come to a place where basically, so let me see, yeah, right. So you had this zone in April, July last year where there was some amount of consolidation, I would say, that happened in terms of forming tops and bottoms and resistances and supports and all. And we've come down to this level. This is a weekly chart, by the way. And in the last, 6 months, we did a sort of double, or even I would say, we could say triple bottom at this level of around, so that's at 7,550 for all practical purposes. And this is one candle here, which was good. There was another candle here, which was good for another bottom. And, maybe this one was also okay. But the nature of this last candle, what is being highlighted here, is the last week's weekly candle, and it is quite it's very strong. It's a big Marubozu type, very large volumes, definitely, and therefore the selling pressure on a longer term basis is very much intact. And then what you have here is today's candle on a weekly chart, and well, it's early days, and remember, I was going to say Shankranti, but that's fine. The markets are open, I think, right? Please correct me if I'm wrong. And what we can see here is that it has actually tested this level. And if we go to the daily chart, so we've got well, you could say a spinning top. There was hope on Friday about this move down, that this was a spinning top, but today we gap down, etc. And then you've got this gap which is there, right? So this gap which is there in the market, okay, a down trend gap, a down gap rather window, and that's again a sign of bearishness. At this point, all we can say is that we seem to be very critically poised at the market, and we are at an important juncture of around 7,500. And if 7,500 and then this level of around 7,000, what is this? 7,430, that would be a level to watch out for. 7,430 breaks, then 7,268 and then 6,364 are levels that are definitely possible and foreseeable, right? Now this may sound far-fetched at this point, but well, better be prepared rather than lick our wounds later. So just keep in mind, I think we're at a very critical level, and at this point going long on the market is probably a high risk strategy. Looking for bounces to short is probably the best thing that you can do, right? So I'm repeating this just in terms of ample precaution to say that things are really not looking good. Don't be in a hurry to go into the market and buy things out. Now, this is something I've said before, and I want to say this again, that the market and technically it tends to really test important levels. And what I have been saying in the past, oh, where did so many lines come from? All right, make it weekly, it'll be cleaner. Yeah, thanks. Okay. Yeah. Okay. So what I want to emphasize here, and could easily be wrong, is that the multi or the triple top, okay, of 2008 here, right, and then 2010 there, and then 2013 here. That's a triple top in my opinion. A triple top which all consists of at that time, the life highs at that time at around 6,300 is a level that has not been tested at all, right? And tested as support, that is, just to be clear. And it is the nature of the market, it's at least technically speaking, to test these long-term levels at some point or the other. It is my expectation that at some point it is going to test 6,300. When, I cannot say. How, I cannot say. I don't know if anybody can, but that is something that I expect will happen, a high probability. I should not use the word will, at some time. In my opinion, the earlier that happens, the better it is. Okay. Uh, Given the overall environment, you've got, you know, so let me come to India here, right? All right. So we have GST, which is still, you know, on and off, and all that's fine. Growth is really not happening, right? So in spite of all the hope that was there, growth is really, really not happening in the way, I think I should qualify that, in the way has been expected for the last 2 years, right? Just a second. Okay. So year after year and quarter after quarter, there's been disappointment in the economic growth in India, and there is really no hope this quarter either. Things like, just, I think, politics and policy have really not happened. Grassroots stuff has still to happen. And there are some commentators, by the way, who are now talking about better economic growth only after another year or two, right? And this hoopla that, okay, now that India is, growing faster than China, is all fine in terms of patriotism, but I don't think it's going to make money at this point. So, there's really nothing very encouraging on the Indian economic, political, or policy side to say that things are getting better. And this, my point out, and this is in spite, uh, SPI, or despite, whatever, of lower crude oil prices, right? So the government of India has raised excise duty on petrol and diesel several times to take benefit of that. So that's why the retail price is really not going down as much as it should. Petrol is 60 plus. If the excise duties had not been increased, then petrol will probably be around $50 and diesel at around 25 or $30 or something like that. So the government is minting money out of this lower crude oil prices, and fine. I mean, I think all of us are quite just used to, the system has just gotten used to 60 rupees, and we are happy to pay, and that should improve the balance sheet of the country, so to say. And to that extent we can hope for maybe something good to happen out of that. But really, nothing much seems to have really gone well for uh, the Indian economy as such. So I think growth to kick in, to for things to happen, we still a distance away from that, and we shouldn't be too optimistic on that front at this point, right? Mm, Elections are happening, right? So I'm not good with my pronunciation. You've got uh, what what is that? bullfighting thing in Tamil Nadu and all, things like that are going to happen, right? And you're going to see more and more opportunistic stuff that's going to happen in the short term, and really not too much happening on the economic side. So that's as far as India is concerned. That's just a very quick overview, so not too much hope there. So having said that, if we come back to the chart, so that's Nifty, and we'll look at all the Nifty other sector indices in a while. So just to combine that and complete that maybe with the fundamental side of things. So this is the Nifty PE chart for the last, I mean, ever since it's been available, and this is something that I'm sure some of you have seen before. So nothing really new here, and you know it's so where is it in terms of valuations, right? So in terms of valuations, we are probably looking at we are looking at 20.56 right now. So this is the latest data that's for today, all right? And therefore we are definitely below average, right? The long-term average is around maybe 1920. So we are getting there, and on a valuation basis, things are definitely looking, I would say, healthy, right? Now here's the problem with this whole setup. We can say on a valuation basis things are looking healthy, but the big problem with that is that earnings or EPS is not growing in the way people are expecting, or the analysts have been expecting. And with this, EPS actually not doing too well, the question is, if the economy or the EPS doesn't do well. So one of the biggest overhangs, as perhaps some of you have been noticing, is there's a lot of talk about NPAs in banks, and the jokes about how banks are at 52-week lows, I think, or something like that, while the companies that who borrowed from it are at 52-week highs, the real estate and the power companies and all that. And this stress is now showing up. So banks are going to have to write off a lot more loans. There's been a change in RBI policy about how quickly they should write that. So lower EPSs and lower profits on banks should be expected in the coming quarters. So that is something else to keep in mind. And if bank EPS comes down, and as we all know, banks are a pretty significant part of um, the Nifty weightage, right? So right now, it's just not looking very good as far as the PE is concerned, and really good support for the PE levels seem to occur in India at around 19. We are at 20. Okay, so we are not very far from there. 19 would start to become attractive on a forward basis. This is on a historical EPS trailing 12-month basis. That if you say 20 to 19, we're talking about 1 on 20, we're talking about at least a 5% correction in terms of price for 19 to happen. So if you say at least a 5% correction, then we are talking about what, from the current price of 7,500, 5% will be around 350 points. So 350 points takes it to about 7,100, say 7,000 levels. So even on a fundamental basis, it's not like we are cheap and you can expect money to be rushing in. That's certainly not the case. And therefore, we should definitely be aware of that. Now, just in case, to complete things, let me add, I think, Nifty EPS. Yeah, right. So here's the proof that fundamentally things are not really good, right? This is the Nifty EPS chart. Some of you are probably seeing it at least from BIC for the first time. We've been doing some work in the background with this, and well, so here's let's look at it from a broad perspective. After the 2008 crash, you had EPS. So please note what we're talking about. This is actual absolute earnings per share, right? We are not talking about a PE ratio. We're not talking about any ratio. We're talking about the actual Nifty earnings for all the 50 companies weighted accordingly. So you can clearly see that in 2008, there was a topping out of the EPS. It didn't really do well. And then in 2008-9, the EPS actually fell from, let's get a fix on this, from about, 240 levels, right? Or even, not even 240, 238 levels to 210 levels. So that's about a 10-15% fall in EPS in just about 1 quarter, as you can see here, if you can just follow my mouse, right? So, and what you see here is in a sense a repetition of that. Should we say that we 390 EPS, and then the 390 EPS has right now come down to 360, which is not such a big deal. It's just 10%. It's not as much as a fall as had happened here, and you're seeing an improvement in EPS now on a trailing basis, right? Now, has the EPS bottomed out? Okay, that's really, I think, the question. So right now, unfortunately, after having a really good uptrend on the EPS quarter to quarter for the last, not that you can do technical analysis on EPS like this, but I think just to get a perspective, clearly EPS was rising for the last 6-7 years, and now the EPS uptrend is clearly has been broken down, and then we are now seeing an uptick again, but so this is flat because there are no more results and we have to wait for the next quarter. And if things really don't pan out well, and the expectation is that the EPS is not really, the earnings are not really going to be healthy, then you could, here's the thing about those of us who follow fundamentals. If in this quarter, forget about EPS going down, if the EPS doesn't go up, that's it. If the EPS itself doesn't go up, then that's not a healthy sign, right? And so we'll have to wait and watch. So we're looking at second week of January now. Third week, you'll see the rush of third quarter financial year results coming out. So it'll be good to watch on that, and it's time for event trading again on a case by case basis. So EPS not doing well, and PE ratios, like I said, still on the expensive side. So I think this is one important thing that we need to keep in mind, broadly speaking. So both technically and fundamentally, things are not looking healthy at all, right? Okay, if there are any questions or anything, please put them into the chat box and I'll be happy to answer them. Okay, so having done that, let's get back to the rest of the indices. And I just want to quickly do the broad indices before we um, um, get into individual stocks. Now, before I do that, let me introduce you to something that we've done. Okay, so just going to put, let's see, 50 here, right? Okay, so what you see now, I hope it is clear at your end. I'll take some time to explain it so that you're comfortable with what we are really looking at, because there are a lot of things on this. Is that this is called a relative performance chart. Okay, this is not a price chart. Let me make that very clear upfront. This is not a price chart. This is a relative performance chart of a set of stocks, in this case a set of indices that we're going to be tracking. Earlier, if you remember, we used to do this index by index, but what a relative performance charts allows you to do is look at all the indices together one shot, and very quickly visually know which are doing well and which are doing badly, right? A very nice feature that is there in this AmiBroker tool that we are now using. So what you can basically see, so if you're right on top here, and that is the what is this healthcare index. So okay, let me just take a minute or two. A relative performance chart just takes the base value from wherever you want, and if I scroll out, it'll always be taking it from there. and it takes the base value and it considers that to be the start of the price. And every point that you see here is basically how much higher or lower is that day's price from the base reference price. So you can just take this day by day, week by week, month by month. So essentially, if I put it right at the end here, and if I look at let's say, let me just illustrate this better. uh, I want to just take a reference point. So I have adjusted this to basically look at, say, 1st of April, right? 1st of Jan 2011. So let's not go so far. Let's maybe go to 2013. And we are essentially looking at a 2-year performance now. Okay. So for all practical purposes, right on the left, at the left edge is the 1st January 2013, and this is updated till today. And had you invested on the 1st of January 2013 in healthcare, this is the cyan line right now on top, you would have made a 95% profit if you had done that in the healthcare space. And right at the bottom, if you look at it, if you had done it in I'll just tell you what these numbers are. So you had done it in realty, if you had invested in realty, if you had invested in uh, and metals, you would have lost 30 to 70, 30 to 40% loss you would have had, because this is all minus 39, minus 42, right? So in the 2 years, you would have basically been down 30 to 40% in realty and metals, while you would have been up by about 95% in the case of healthcare. In right in the middle here, where I've put this yellow horizontal line, that's zero, is -1, -5, and that is BSC power index, and the -1 is infra. So essentially, you have not made money. Now, if you look at this, the thing in this, what is very interesting to note is that none of the indices right now, right on top, are still continuing to trend up. Okay, and of course we can see each of the indices, and we are going to do that in a little while, but none of the indices are actually trending up in any time horizon that you wish to look at, right? As a matter of fact, if I look at the shorter term thing of just 2014, you can clearly see that almost everything is now trending down. So in the earlier part, maybe at this point, and let me, yeah, in this zone, you saw there was a clear uptrend. So this was 2014. In 2015 also, some were trending up, some were trending down. But if I look at the last, let's say, from this point onwards of July last year, then everything is clearly trending down. If there is any hope, then there is possibly in realty and metals, which are no longer trending down, but they seem to have made a base here, right? So I'm not saying you should buy. Please note that. Okay, this is not a session on recommendations or anything like that. This is just observations and what the charts are telling us, right? So at the bottom here, for the last 6 months, it looks like reality, it looks like metal has bottomed out. It also looks in this zone here that things like FMCG and BSC power have gone sideways, but anything above that, and that includes auto, capital goods, healthcare, Nifty or bank Nifty, everything is just now trending down, right? So the purpose of looking at this is to save a tremendous amount of time and get a very quick fix on what sectors should we look at, right? This is going to save us a lot of time. You're going to find that the IMRs going forward will perhaps just be shorter than what we used to do earlier. But on the other hand, if we've got interest and we've got time, then now we've got data like this to look at fundamental stuff and take fundamental views. Earlier we were not doing much of fundamentals, if you remember, but we are now going to include that in the IMRs going forward. So those of us who are positional traders and investors, I think the IMR is going to serve them well and better going forward. Earlier it was more, I think, trading focused. Now we're going to have a perhaps a more balanced trading come investing focus in the IMRs. Okay, so coming back to the situation, things are not looking healthy at all on many fronts. If there's anything, there could be accumulation opportunities in realty and metals. But having said that, please note that if the Nifty does crack, all right, as may happen, then everything that is cheap will just get cheaper also. So there's really not much, no need to hurry in terms of getting in. Okay, so that's there. Let me, I know I keep sometimes doing all sorts of things and a little bit disorganized. My apologies. Just thoughts that keep coming in. So we've got Middle East to worry about. Okay, I'm just putting down factors that we need to be concerned about. Syria, I'm not including that in the Middle East. In the Middle East, I'm talking about Saudi Arabia, Iran, low crude oil prices, and how that's going to impact their economies. So not looking good. So Syria is basically proxy between Saudi Arabia and let's say US versus Iran and Russia. Right, but this is interesting because Saudi Arabia, Russia and US now seem to be uh, coming together as far as ISIS is concerned. But this whole thing about Iranian sanctions being lifted by the US and the rest of the world by default is going to be a really, really interesting thing to watch out. And we're going to it'll be fascinating to see how this whole thing pans out on the stability of the Middle East in the years ahead. Right. So I think this is a big issue, an issue that could easily be, flare up. Saudi Arabia is very unhappy with the freedom Iran now has. And here's the other thing. So Iran has really not yet started pumping out crude oil, and they need the money desperately. So as and when they do, which is just a matter of time, there's a good reason why they're just going to sell at anything, because they were not getting this oil out earlier. Now they can, and they're going to make millions of dollars. And they're not going to care at what price they're going to do that. So keep that at the back of your mind. So crude oil, really no hurry for it to go up at all. So the government of India is pretty happy, and a lot of countries are happy. But unfortunately, that crude oil, very low crude oil prices, means the whole of the Middle East and crude oil producing countries have a very, very bad economic situation. You take Venezuela and how that has collapsed, and if you see how Saudi Arabia had the biggest deficit this budget, and that's across the Middle East, by the way. And a lot of that money was going into business, infrastructure, salaries, etc., which got back into the third world countries, into repatriation into India and Africa and Sri Lanka, Pakistan, Bangladesh, Indonesia, Malaysia, etc. So if the Middle East countries have less money, there's less money going to be coming back to these countries also. So it's on a big circle, which had a nice stability to it till I think a year or two back, but now that whole thing is being completely put to test today, right? And nobody really knows how things are going to go. Okay, so these are issues that are not going to run away. We talked about Greece. We think it's gone away. It really hasn't. It could easily come back. It's just that it's not on the headlines again. We're talking about China now, and we were not talking about China. When you looked at the Chinese index, it fell so much, 3 months back. Then they put these artificial controls on short selling, on promoters not being able to sell for the 3-month ban, and that ban has either gone or is going to go, and that's why the markets are again falling in China. And if you read the news, then China has suspended circuits, right? The 7% circuit that they have is no longer going to be there. So if there's going to be a fall, they're going to just let it fall, right? I'm not sure what the reasoning is behind this. So these are things which are there. And if China, the Shanghai index, just decides it's going to go down 10-20% on any day, today, tomorrow, we should, China is where everybody is now worried about. then no reason why Nifty should not go down, right? So these are all related, interconnected events, as we know, and we need to keep that all in mind. Okay. Okay. Right. So we were looking at NSE, and so now let's look at the important sector indices and take it from there. So this is the Bank Nifty, and I don't know if anybody noticed. Really, I'm going to click Nifty again. All right. So just watch. So this is Nifty. Okay. I'm going to give it a moment to change at your end. All right. And then this is Bank Nifty. And really, if you look at it in the overall structure, really not too much of a difference at all, right? More or less, can't say mirror images for sure, but pretty close to that. And if we zoom in to quickly look at levels, then sure, you've got a level here that may hold. Are we looking at a double bottom here perhaps in the future? That is definitely a moot point, right? So that was a daily chart. This is sorry, that was a weekly chart, and now we're looking at a daily chart. Okay. Now if you look at it, okay, this is interesting because there's a slight an important difference. On the Nifty, it broke down through the triple bottom in a sense, and uh, came back up today. Somebody could argue quite correctly that that has not been broken. The low has not been broken on the Bank Nifty, and there is therefore some strength on it, right? And that is exactly where we are right now. But I think, like we've been saying, you need to keep results in mind and look at how the NPAs thing pan out. Uh, there is Prabhakar from Chennai who's saying that federal bank result tomorrow, probably a short opportunity. Well, possible. Just have to watch all the results from now on. And if the results are really not good, then there's no reason why this bottom should hold and things could really, really get out of hand, right? Now, and the thing I want to emphasize is if you look at the volume picture, you can clearly see it's going down on higher volumes, but not really going up on good volume. So a level to watch on the Bank Nifty is definitely 15,760, and if that 15,760 breaks, then definitely lower levels on Bank Nifty to 15,000, and then if 15,000 breaks, who knows, 13,000. And coming back to the triple top situation, one second, yeah, right, you're talking about Bank Nifty really getting very good support only at around 13,300. So that's another almost 3,000 points down from here, and that is about what, 20%? Yep, 20%, 18 to 20% lower from these levels. And if the results are bad, then that is definitely on the cards, right? So that is something to keep in mind. Really good support is only at around 13,000 in my opinion. There is some support at this level, so let's put that there. Okay, I'll just put it as a zone at around 15,000, and of course you've got the 200-day moving average there at 14,500. But well, we'll wait and watch. Now, talking about moving averages, one moving average after the other has been, there's a what is called a dead crossover that has happened, okay, including the 50-day, including the 100-day now, and then you've got only the 200-day standing lower, right? So really nothing hopeful at this point. Sorry, this has I need to rephrase. That was weekly chart, so my apologies. So this is the daily chart. Now if you see the daily chart, it's below all the long-term moving averages also, right? So really no help here, and you're clearly getting lower tops and you're getting lower bottoms still here. Whether the support breaks or not, we'll wait and watch. I think we're going to know by Tuesday or Wednesday, right? Definitely this week. Okay. Just looking at some other stuff. So on this template, I've got multiple studies put in. So this is RSI and stochastic, and well, no hope in that in case anybody was looking for a divergence. On the MACD thing at the bottom, you can clearly see that things are just actually getting they're not getting better at all, right? They're definitely not over zero. It's not like the divergence, MACD divergence is, or the signal line and the divergence is decreasing. So not much hope there. And then if we look at, so one of the things that I'm going to be doing moving forward, introducing new, is doing volume studies and looking at how we haven't done volume studies in the past, if, as you all remember. We're going to include that in the sessions going forward. And the volume studies will tell us, money going in, money going out, smart money, etc. Would definitely encourage anyone who's not done volume studies to read it up and be up to date on that. So neither on the price volume trend or the OBV, the on balance volume, are we seeing any hope that this downtrend could perhaps be over. As a matter of fact, if anything, then the price volume trend, especially here, is clearly showing that things are actually getting worse. All right. This is, I think, really, I think we can skip that in terms of, we'll do this at some other time. So what I've got on this is relative performance with the Nifty. I've got the beta value of the Nifty in this pane, and then I've got the average true range for 5 days or 5 periodicities in this, and the last one is then ADX for telling us directional. And you can very clearly see on the ADX side the red line, which is the minus DI, going up and trending up, and the ADX value itself is also at 23 and it is going up, 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 right? So just telling you that things at this point seem to be quite committed on the downside. Okay, so that's on the bank Nifty. Let's look at the other big one, CNX IT. We'll look at the first chart. Okay, so if you want some more bad news, well, here it is very clearly. CNX IT, today's candle is not green, right? If anything, it is red, and it is done a very, very nice tweezers bottom, and tomorrow will be a decider on whether IT goes up or down. So you've got tweezers bottom here. So what's the low here? Let's see, 10,799. The low here is 10,797.7798. Okay, 1.3 points away. That's as good as it gets, practically speaking. That news not good, going down on higher volumes. It's below all the moving averages, and if this one breaks down, the CNX IT is likely to go down further. And so what levels are we talking about? So the rupee itself, right, the USD INR, 66, 67, that's what it's been fluctuating down, and if it breaks 67, then that's a big help. But you know what, this currency thing, I don't know if the devaluation of the rupee potentially is going to be good. You've probably read news that the Chinese yuan, which has gotten devalued, I think it's at a 5-year, 4 or 5-year low against the US dollar, is going to make Chinese goods much cheaper, and that is a threat for India. Apollo Tyre has made a statement that they are finding it difficult to compete with Chinese imports, and those imports are going to get cheaper going forward because of the devaluation, simply because of the devaluation. And well, if you want to, then you want to say compete with China, then we also have to devalue, except that ours is, of course, not a managed currency peg, but a free float market driven issue. And who knows, 68, 70 could easily happen on the USD INR. And if that happens, then will the IT companies benefit? Well, they should in the short term. But I think by now we have enough people in IT, in BIC, and if you talk to them at some very senior levels in some of the IT companies, both from the customer side and the IT vendor side, and I can tell you that things are really not that rosy. Margins will get squeezed. The company client will come back and say, you know what, you're making more, so you can give us a lower price. If not, we're just going somewhere else. So things not really good in terms of business, I would say. Okay. All right. So one more thing to note on the chart is, you know, you're looking at this level, which is pretty critical in my opinion. Okay. So this level was cool, but we'll make that thinner, right? This is like 1, 2, 3, 4, 5 bottoms here. And if this level breaks, and this level is 10,690, right? That's the level to, I think, watch. If this level breaks, then where is support? Really good question, I would say, right? So where is support? And if you look at the long-term charts, then let's see, right? Okay, maybe that. I'm just trying to be optimistic here, right? So that's probably okay. So even if we say that's where some support is, then that is at 10,300. We are at 10,800. So another 500 points down. You're talking about a 5% correction before we come anywhere close to some decent support. So now we are on a weekly chart, and clearly the trend is down. Okay, could be some support here, but I think that's probably set to break down in my opinion. Okay. Again, if you look at the volume here on the bottom, you'll see that weekly volume downside is much higher than up. So IT, not much hope. Let's look at FMCG, right? Or let's look at reality. No, let's finish off FMCG. Okay, so this is FMCG, and again, not too much of support. So IT was down, but this one is green today, and that's nice, of course. But again, you can look at this important support level, which is 19,030, and that's a 1, 2 triple bottom that we have. And if triple bottoms, if you look at Doe theory, I say triple bottoms are good places for support. Sure, let's see if we have anything on the indicators to help us there. And well, no, not really. We have no positive divergences. We have nothing on stochastic or RSI to help us here or to give us any reason for hope. There's really nothing significant on MACD. In terms of the volume studies, well, there's nothing here either, right? Neither the PVT nor the OBV is very good. And if you look at something like the ADX, then this is like just wanting to take a, I don't know, I just got this picture. It's like on, if you can imagine a cobra trying to strike out that red line right at the bottom. So I'd be very careful. Looks like uh, um, FMCG is also really not holding out at all, right? So that's FMCG. Usually FMCG, by the way. So let's look at pharma, and then we'll come back to FMCG and discuss that together. So CNX Pharma. Oh, so sad. This is interesting. Both the big sectors which earn a lot of foreign exchange, IT and pharma, had both red candles today. Right? I'm not sure whether what to make of it, but it doesn't look happy to me at all. Right? In a environment where the rupee could get weaker and that would be good for them, these guys are not really reacting at all. And if anything, with all of these sectors one by one below the long-term moving averages, any bounce up, right, is going to be met with significant resistance, which is very close in terms of your 50-day, 100-day, 200-day moving averages, and of course the short-term moving averages also, right? So that's another technical point to think about, and also this whole thing about the two big, large export-oriented sectors in an environment where the rupee could get weaker, they are not benefiting. So now I'm wondering, what's it doesn't look happy to me. It doesn't look bullish to me at all. If anything, I'm reading this or interpreting it as a negative signal. And as far as pharma is concerned, if this level breaks, which is at 11,300, then I think 10,500, 10,600 is very, very much on the card. So that's almost a 10% correction on pharma that you are looking at. So that's and that 10% correction could easily take a week or two or three, right? So it's not something that will happen in a hurry. In By the way, just to point out, so you've got, as far as pharma is concerned, uh, for all practical purposes, in my opinion, let's say 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 down days. I'm including this green candle also in that. Right, 10 down days, really no upside correction. And if you do get a bounce, that'll just be a bounce. It'll be a correction of the downtrend, and then the downtrend is likely to continue after that. So that's where pharma is. Let's look at any BSE indices. Yes, we need to look at capital goods. Right. So if you look at capital goods, hmm, this is a textbook lower top, lower bottom chart. Anybody new to technical analysis, you should show them this chart, right? This is exactly what lower tops, lower bottoms in real life look like. Right? Not everything will fit on a line, and when it does, then also it's sometimes a little erratic. So this is capital goods. So capital goods also really doing quite badly, and so they haven't even reached there. So one sector which has grossly underperformed hasn't even gone back to its 2008 peak, and now it's back to its 2011 levels. So in terms of valuation, I don't know. We'll have a look at it at some other time. But this is interesting. So, okay, let me point out something here, right? Uh, so please note this support level at around 13,980 and how it held for actually almost 2.5 years. But when the time came to break this, it did break it, and then it just look at the how it broke and how you got Marubozu type red candles, and it's just come down. So today you have uh, uh, hammer, okay, doji hammer almost, right, or dragonfly if you want. But I really, there's really nothing to say that you should. It's a bottom has been put in place. If anything, a move up to 14,000 should be used to short. So FMCG. Uh, Sorry. So I missed something that I wanted to say. So I'll finish with FMCG. I'll come back to that. So this level very important, and watch it 7,000 for 12,750, and once that breaks, then that level, and that level is at around 11,300. So you're talking about 15-20% down on FMCG from current levels after already having fallen so much, right? Yeah. Okay, so I did mention that I wanted to connect pharma and IT. I did that right. Okay, so that's consumer durables, sorry, capital goods, and then let's look at metals and realty, right? So if you look at metals, well, picture says it all. This is daily right from 2006, and you can see the very nice downtrend here, okay, which started in 2014, and is question is it now bottoming out? Now you saw that in this chart, if you remember, right, that the metals and the uh, pharma space, right? Sorry, yeah, metals and what was that? Realty, sorry, metals and realty seem to have bottomed out. It's too early to say, but if I look at the metal index here, then sure, 2013 bottom, 2015, 2016 bottom, and there was some support level in 2006 also. So almost over a 10-year period, this level has been important. And if we zoom in, you know, so you've got a nice triple bottom that is happening in this chart, right? So 1, 2, 3, 4, and the longer term moving averages seem to be bottoming out, especially the 50-day moving average is, I would say, is going sideways now, and then the 100 days, the steepness is reducing. By no means am I saying that this is a buy, but I'm at the same time saying that you should perhaps not short this at this point, right? It's too, these are not places to be thinking of shorting. If anything, the move from 14,000 to 7,000, that means price has basically become half in the last 1.5, 2 years. That doesn't mean it's a buy, of course. It doesn't mean evaluations are good, but it's quite possible that this is a bottoming out process that's going on. And if anything, I think this is the one place, maybe apart from this reality, to watch out for in terms of a possible buying opportunity in the days ahead. So I would say that do not look at shorting metals. Okay, let's see if there's anything on the indicators. Well, can't say there is anything, yeah, what would I say, significant. There is really no, bullish uh, divergence at this point. Okay, and the leading indicators really not uh, providing any additional help. MACD, well, one thing that's very clear about MACD, it has gone to a neutral zone, and from being consistently in the negative zone from let's say from here onwards, which was May last year, or even from here, for except for a little bit of going up there, coming to the positive here. The question is whether this is just another temporary up move and coming down, but at least that negativity is out of the indicator, which is a good thing. ADX wise, so this is ADX, the ADX value itself is below 18, which is not a satisfactory signal in terms of strength, in terms of reliability. And right now what we do have is actually uh, um, a negative signal, right, on the ADX. But this is a sideways market, and you should really ignore that at this point, right? By the way, I just want to make sure, in case there's a lag which is really large or irritating between the video and the audio, please do let me know. I'll just put small gaps between my commentary so that the video catches up. So if there is anything like that at your end, do let me know. Yeah, thank you. Okay, So that is metal, and then we're looking at realty, and well, looking quite the same. So if you look at the realty index, it is certainly not at its life lows, but it is close to the life low, and uh, right. So that's where you have it, and actually quite interesting. A pretty healthy green candle both yesterday and today, as far as realty is concerned now. So there is definitely outperformance going on here as far as realty is concerned. Okay, again, not saying you should buy it, but on the other hand, if you are somebody who is really a long-term investor and can is willing to risk 10-15% correction for any reason, because I think the big event risk right now, by the way, I think I should have mentioned it before, is China, right? If the Chinese market just collapses till some time where you've got, let's say, a decoupling, as the commentators like to say, between China and the rest of the world, I think till then it's really, really going to be tough, right? So if you are willing to take that event risk, then you should definitely be looking at realty, and both realty and metals may be uh, you know a place to watch. Okay. I'm not making any fundamentals comments on it. I don't think we have the time today. It's already 10:10, so we are almost an hour and a half into the session. So we would want to jump into the Nifty stocks quickly, right? So just to summarize, let me put it in a document. Sector view. Okay, and if I miss anything here, please just ping so that uh, add this as a note, which can be viewed later. Um Except for metals and realty, all other indices are close to or at important support levels. If these levels break, then 5 to 20% correction, or shall I say further correction, is very possible for those indices. Therefore, or rather, that means for the stocks in those indices. Uh, Look only for shorting opportunities, may consider getting out of long positions even now, right? And any long build up should factor in event risk in China, right? So a big uh, what shall we say? I don't think in the Chinese market you've got what is called a culmination event, all right, where just the panic just moves out, right? Uh, a culmination day event has not yet happened in China, right? So that's how usually big falls end, right? Something, there'll be some crisis which just the market just goes on 20% or 10% or something like that, and then recovers that day or the next few days, and that's when a bottom has been put. So bottom has clearly not been put as far as China is concerned, and that's basically, of course, my view. Could be wrong. Never know. Time will tell. All right. So that's the sector view. In case, okay, so metals. Okay. Right. So I did say that. I'm not going to put it down, which was basically if you're looking at metals and reality. The thing about reality, by the way, is that there was a report in one of the newspapers yesterday or today, yesterday before, I think, that the prices at which new projects are being launched is anything between 5 to 20% less than what those prices were last year, right? So that's definitely not a healthy sign, and um, at least for some time, topping out in real estate prices is across the country, generally at a macro level, is I think what's going on, and that is what uh, we should be looking at, right? So if prices are less, then really don't see how um, um, what how will real estate companies really make money and their EPS improve? I don't know. The only thing perhaps which is there is uh, interest costs have come down, and they have sold off large land parcels to reduce debt, and that could be something. So that is something to investigate on the real estate side, but really nothing else on that point. Metals, I'm not really sure why one should be buying them, because unless the use of metals and the profits of the metals companies picks up, which at least from whatever I've read, I don't see, and there's no evidence of that. Um, one should be a little definitely circumspect about that place, right? Okay. Oh, just a thought. So, metal prices have come down. I think steel bars are 30 to 40% cheaper than they were 1 year. And in real estate, infrastructure, construction, and all that. So, one key element of your input cost, which is steel reinforcement price, has clearly come down, and that's definitely a saving. So, that's good for reality, right? What hasn't come down, as far as I know, is your cement price, right? So metal has come down, cement has not, and well, the real estate, labor costs have come down. I don't know. So on the balance, looks like creating and doing construction is a little cheaper today. Uh, Anybody in the construction industry here on the webinar or anything you want to add and let us know how that price is behaving for cost of construction? Has it actually come down? I'm just speculating. So because if it has, then that's good for real estate, right? Yeah, Vishal, thanks for that input. Yes, steel is cheap, but yeah, labor is not. Agreed. So I have the two offset each other. Oh, okay. So he's got another point. Sand is not cheap either. Sand is a mafia anyhow. So really not a free market at all. Nothing that we can do about it, right? So overall, maybe construction costs haven't really come down, given that labor is not cheap and sand is not cheap. And uh, I don't know how much of steel is a component of uh, overall construction, right? And then, of course, you've got permissions and corruption and usual other stuff. Ah, okay. So this is useful information. Vishal says that steel cost of steel contributes 15% to the overall cost of construction, right? It's definitely smaller than I thought. I'm not a engineer, so I have no clue. So a 40% reduction in that 15% component is approximately what? A 5% reduction overall, which is, unless you're building massive projects. And then if your overall cost of sale has also come down, well, really nothing great here, right? So if your cost has come down by 5%, but your selling price has come down by 5-10%, then that's definitely not good news, right? Your margins haven't expanded. Okay, So that's the sector view, the India view, and then we can now look at and yeah, I just wanted to add, okay, the red candles today on pharma and IT sectors uh, probably does not bode well for what these sectors are likely to do in the coming weeks, right? And like I said, especially with your possible depreciating rupee, even if that has not helped, then that's something to keep in mind. Okay, so coming to back to the chart, so we've done with all the um, uh, large cap based sectors and all. Let's just very quickly look at mid caps and see if there is anything. And well, mid caps clearly I think showing some strength. There's no doubt about it. So this is the daily chart, and you can see that they did of course go up, and they haven't fallen as much as clearly the large caps have. Okay, so there is definitely strength, and you can see that the mid cap index is above the 200-day moving average and very close to around the 50 and 100-day moving average, right? So looks there's very clearly the mid cap companies price wise are doing much better than the large cap. Now, having said that, is there any reason to believe that this could continue? Unfortunately, there is at this point no evidence that this could continue. I would say that we just have to you know wait and watch. But I think it's just a matter of time that if the overall market does come down, and the mid caps will also come down, right? Yeah. Okay. So that's on the mid cap side. On the Nifty NSE, one second, where's the junior index? So I look at the Nifty junior, more or less the same story as the mid cap index in the BSE side. Uh, so clearly the losses are happening on the large cap companies, and think about this. It is usually the large caps that give the signal first. Okay, they react to bad and good conditions early, and if this is going to trickle down into worse things for the overall economy, then it's a matter of time that the mid caps also come down. So for whatever reason they are staying up, there is definitely a divergence, you can say, between large caps and mid caps, and if the markets do bottom out, then the mid caps would be the ones to buy. Those will probably, not probably, will rally much more than the large caps do. But at this point, like I said, there's really no reason to believe that these markets are likely to move up, and therefore the implication of that is that the mid caps would also perhaps move down. And since the mid caps have really not moved down a lot, and this is where our, by the way, our relative chart really helps. So if you just look at this, the blue line on top is the mid cap index from, oh, this thing is gone. Let me just get perspective back. Then we timelines. Okay, so from 2014, let's say, all right. So this is from January 2014, and if you look at the whole picture, the what color is this? It's not yellow. It's whatever, light brown. That's the NSE. The Nifty has gone up 20% from 1st Jan 2014, but the mid cap index is up 52%. And clearly the thing is it's not going up anymore. That's one thing to remember, right? So it's really not going up anymore, and it has topped out very clearly. It has topped out. That's the whole point. And but it hasn't come down in the way the Nifty has come down. So if I just put a trend line here, then you can see that this is the way the Nifty has come down. Here this one has come down, and then it has just gone flat, right? So there is this strength which is there right now in the mid cap index, and it'll be interesting to watch, because here is how it plays out on both sides. If the mid cap index, if the market recovers, then the mid caps are the ones you want to buy. If the market goes down, then the mid caps are the ones you want to short, right? Because they haven't fallen as much as they perhaps could. So I'm just talking about relative strength, and one thing catching up with the other. But on the other hand, if you're looking at just the IT index, pharma index, how the red candles there, and many of the other ones at important support levels, there are plenty of, I think, shorting opportunities. Okay, so with that, let's quickly glance through the 50 stocks which are there in the Nifty. And if I'm not going to go through each one in detail, but let's do that in terms of finding any particular opportunities that you could perhaps trade in the coming 1 week, right? Now, before I jump into that, I'm just going to take a small 2-minute break, and I'm going to be back, right? So drink some water, whatever, freshen up, and be back in 2 minutes exactly. Okay, so starting with ACC, we'll go in an alphabetical order today, but I'm going to have this rearranged next time sector wise, so that we can finish one sector at a time and do that and get a much better picture of the sector that way. Okay, all right. So I don't know. Let's use this as a good, I think, teaching opportunity. You've got a very what would I say? It's not unique, but the important candlestick symbol, sorry, pattern here, which is a tri-star, right? So this whole move here is a very, very nice and a very, very textbook tri-star candle. And what's so deceptive about it is that before that you had this fantastic move on volumes, right? And everybody would be justified in saying it's going up, going up, going up, going up, and then in 2 days it's just actually in 1 day it paused. Then the next day it came, gave you a big red candle, and if nothing, the next day after that was your exit sign. And if you did not, and the price was 1700, well, you're paying for it, because the price is now 1400, etc., right? So just saw it, so I thought we should definitely just mention it. Okay, so this is where the market is, and you can see the last few days it's been going down. If you look at support resistance levels, and that's definitely an important support line that we've just put there, and you can see that it's clearly been broken. As a matter of fact, I probably put it a little bit higher there. Okay, there's one level there, and one level lower there, okay, or even that level. And well, it's clearly broken down. The only hope, or rather signal here, is that the volume is actually, one could perhaps say, overall maybe just trending down a bit, and there may not actually be too much of a downside perhaps, right? So if you look at OBV, right, and the volume chart on this, you'll see that the the top line, that's price volume trend, actually has gone flat even though the price has gone down. So some sort of a divergence, you could say, overall, but really not enough to, I would say, buy it off at this point. Okay, so really no hurry on that. Nothing on the indicators at all. So on ACC, looks like the deal clearly is still on the bearish side. Oops, where did that go? I clicked something else. Sorry. Okay, so ACC clearly on the bearish side. You can see that it made a hammer yesterday and looks like it made a hammer today, low volume. So have a look at it. Maybe it is forming a base, right? And if it does move, let's say above, I would say 1320, then that would be the time to buy it. On a long side, this is a good stop loss at 1270. But if it does break down quickly, I mean, if there's that event risk in China, then it could just collapse. And where would the next support be? Let's put a level on that also. Right, somewhere in that zone of, I say, 1200. I think we just keep it there at 1200. All right. Yeah. So looking to form a base, but I would be a little very circumspect about that. Ambuja, well, definitely if you're looking to buy, Ambuja is looking better. You can see that ACC broke support. Ambuja is actually formed a higher bottom at this point, right? If I just put that tentatively, there could be a higher bottom there. So if you're looking to buy, then clearly Ambuja is a better one. Let's see. So 190 is clearly a decent support zone as far as Ambuja is concerned, and it is something that one should watch out for. If it does not, or even if it does come to about 192, 193 and all, and thus managed to hold that, then this would definitely be a good place to buy. Here's the problem, right? With all these things, you can see that clearly when it went up, the volumes are down, and that when it went up, sorry, when it went down, the volumes are high. So going up on low volumes and going down on higher volumes, which is definitely not a good sign. So having said that, maybe a higher bottom here, just sit and watch. I think we'll probably find better opportunities. By the way, in case it does go back up to about, say, 200 rupees, right? Then I think you're going to find some really good resistance there, okay, at 200, now that it has sort of settled there. But there is, yeah, for a strange reason, around 205, 206, and not around the psychological number, there seems to be a lot more resistance. So any move up should be considered for shorting, especially more in ACC. But on the other hand, only committed long should be taken only if it goes above 206, 207. Okay, all right. With that, actually, let's look at Ultratech also. Okay, all in the cement space. So Ultratech, is this a potential triple bottom of some sort? One here, second one there, and a third one there. The problem again with this is the volume picture. In the last 1 week, you can see down on high volumes, up on so-so volumes, but 2650 is potentially a good support, but massive resistance at 2,850, right? That's the whole issue with Ultratech, right? And if we take that, okay, oops, where did that come from? I didn't want that. Okay. Okay, so below a multi-year support, possibly forming another support, and we'll just have to wait and watch on this. All right, 2,500 potentially good support. Okay, the trend lines. Okay, let's go back. Asian Paints. This is certainly interesting. Asian Paints, because it hasn't really gone down, right? Really good relative strength. You're going to see it here, right? So really good. Like I said, this line here is the NSE 50, but this one is doing really well, and across many time periods, across the last 1.5 years, right? So this is definitely bullish, except that at this point it is going sideways more than, definitely going sideways, not going up at all. And so the big plus for Asian Paints, of course, is the much lower production cost. In paints, petroleum, crude oil derivatives are one of the most important input costs, and that price has significantly gone down. Given its remarkable strength, I must say, and close to its life high, I would definitely say Asian Paints should be on the buy list, on the buy watch list. Okay, not buy list. We should be on the buy watch list, and at some lower level, this would probably be a stock worth buying. Please keep in mind that since crude oil is expected to go down even further, the impact on a company like this would be even higher. So Asian Paints, things like Castrol, things into lubrication and all that are very happy people at this point. Okay. Next, let me do some of the odd companies, and then I'll do some of the bigger ones like Auto Group and banks in a little while. So BHEL, just going down and down and down. So very clearly you've got a nice downtrend there. Okay. All right. So that's a nice downtrend on PHEL. It's at about 150 bucks right now, and I don't think there's any hope of it at this point to hold 150. Definitely at a psychologically important level. Okay, so if BHEL breaks 150, then can't there's no reason why it should not go to 100 also. Okay, so if I look at the weekly chart, the only thing to note here is the reduction in uh, volume. Okay, so the volumes have definitely started to taper off, and possibly there is some support at lower levels. That's something to keep in mind. Maybe at these levels at around 130, 135, and you might see a sudden bounce back. But if you're going to be going long on this, then it should be only above 160. Till then, it is definitely a short, but the reduction in volumes that are happening right now is definitely something worth keeping track of. But if it does come down, then one can definitely short BHEL with the stop loss around 152, all the way with the target of 140 and then 135. Okay, then let's look at Kane. Right, so Kane is almost a default crude oil play in the Indian market. Its revenue is solely, as far as I know, derived from selling the crude oil that it extracts from its fields in Rajasthan. It's come down from 380 to 130 today, right? A triple top, which is clearly there, and its life low is at 88 rupees, and 120 is for all practical purposes a good uh, long-term life low. There was also 111. So if crude oil improves, then this improves, but if crude oil comes down, then this comes down. That's generally how the whole deal works. All right, so that's where it is. Nice up move today, nice candle, but I think if it goes to 140, one could consider shorting it with a stop loss at around 142, 142.50, and better to wait for it to break down below 120. And if it does break down below 120, then definitely a 10 rupee further downfall in Kane is certainly possible. That will be a pretty good shot. The other good shot will be if it goes to 140 and if it goes up on low volumes, to be able to short that. Uh, Interesting. Okay, some strength showing up in the indicators, but too early to say. Okay, so that's about Kane. Then, all right, here's Grasim. This is interesting. Grasim doing one really impressive green candle today, and okay, so that's at life high, and generally I like stocks at life high. Has just been my preference, because if they show a lot of strength, and then there's no technical resistance above that, so technically if you look at it, good reason for it to go up. Okay, so there is a good resistance at 3800, and if 3800 were to break out, then definitely one can expect higher levels. So right now 200-day moving average is acting as an important resistance. So you have a range of long-term and short-term moving averages all squeezed together in a what about 100 rupee zone, and you never know which resistance is suddenly going to play the part and it's going to come down. It'll definitely be a buy above 3,800. So we are at 3,622 right now. So one should put an alert in your system above 3,800, and if it goes up, then all the way to 4,000 is clearly a possibility, right? Again, not a stock I would short. Let it go to 3,800, see how it behaves there, and if it's showing weakness, then that's the time to short it with a 20-30 rupee stop loss. On the other hand, that could also be a good place to buy with a quick move to 4,000 on Grasim. Okay, then just want to finish off. Okay, okay, let's look at Z. That's another odd one because entertainment, and it's the only one in Nifty. So the thing about Z, I think, is it's okay, right? It is quite far from its life high, but its life high was this 1999 .com type bubble. And let's see where they can get that data properly. Yeah, okay. So that price is at 800, and the stock is right now at 440. So to go there, it'll have to actually double in price. That's just crazy. Okay, but definitely another stock which is showing strength. That's the trend line, and even the moving averages and everything are all pointing up and trending up, and everything. Yep, indicators are showing strength. RSI, just not coming down below the 40 mark at all, so that's a good sign. And then you've got okay, MACD showing a little tiredness. Okay, but that's okay. If that double top of 440 gets broken, that'll be interesting to watch. Today, in a sense, it took support on the trend line and very close to the 100-day moving average, and then it has actually bounced up. So I would say keep a watch on Z for going long, not for going short. Okay, so now let's come to the auto pack, right? Start with Bajaj Auto, and Bajaj Auto clearly going down, not very far from its life high, but below all the long-term moving average 2360. And with that uptrend very clearly broken, then the next level on Bajaj Auto is at 2200, 2360. All right, so Bajaj Auto result is on 13 Jan. Thank you, Prabhakar, for that input. Right, so that's the good time to mention that one should have an event calendar in front of you, and know what are the events that are coming up. So this is very it's a very good example. Thank you, Prabhakar, again for what the importance of this. So you're looking at going short on this, for example, and then Bajaj Auto comes out with good results, and suddenly the market turns up, and day after tomorrow, tomorrow is 12th and then 13th, and you're just on the wrong side of the event basically. So wait and watch, or trade till the event, and then be very clear what your strategy is once the news is out. And also, is the result during market hours, or is it before or after market hours? Okay, because if it's before or after market hours, then the next session the market will react to that, and you could easily get a gap, depending on what the result is. If it's during market hours, at least you have a chance of putting your entry or exit orders and getting in and out quickly. But otherwise, you could be you could the risk is of a significant loss if there's a gap on the other side of your position. Okay, so probably the market might just go into wait and watch mode now for another 1 or 2 days, and this hammer right now is something that you should just keep a watch on, right? Okay, so with that, let's look at Hero Motors, right? So Hero Motors also looking quite the same in terms of the picture, right? So these are all the biggies, and not that it has to happen that way, but if one has done well, then the other one, generally the market assumes, has also done well, and if one has done badly, then everything is bad. So very close to its life high. This is really interesting, right? So Okay. So the thing about this is like there's probably a range between 2300 to 2600 on this, and right now it seems to be just sticking on to the top part of this range, right? So it seems to be sticking there, and this is a smaller consolidation region within that larger zone. Okay. Uh, and well, again, just because of the result season, I would say again, watch out for that. Watch out for Bajaj Auto result and how that plays out on Hero Motors. Right? Interesting. There have been some quite large bulk deals, institutional deals last year on Hero Motors. Wonder what the issue was. It'd be good to go back and maybe read up. You'll get some insight about that. Okay. So so again, it's a very iffy situation. The only other way to deal with this is if you are comfortable trading options. 2505 is where the price is. 2500 strike price put call is there, and one of the things you could do is given that there is an event, look at a long straddle. So buy the 2500 call and the 2500 put. Let the market move, and then whichever is the one which is not making money, you quickly jump out of that and let the other leg run. So that is something you could consider on Hero Motors. No direction, no trend, so wait for that or take a position which is both is bi-directional, right? Okay, so let's look at four-wheelers. We'll look at Maruti. So you know, two things about Maruti. On the one hand, there are a lot of people talking about new products, new um, launches, new variants, etc. The Ciaz has done quite decently well. I'm sure you've also noticed quite a few of them on the road. Then the Baleno has done well. The S-Cross has not. They're doing more AMT versions of quite a few of the vehicles. But all said and done, it is expensive from a fundamental perspective. I don't have the valuations here right now, but everybody knows that Maruti is expensive fundamentally speaking. And the other flip side is to talk about okay pollution, etc. And if there are more clampdowns like Delhi, or there's also this news about India skipping Bharat 5 norms or Euro 5 norms and jumping to Euro 6 by 2020. And well, it's much easier to implement that for petrol vehicles rather than diesel vehicles. And therefore, this is something from a long-term perspective, Maruti could still do really, really well. Technically, it has taken support on the 200-day moving average, as you can see. And then it's a question of what it's likely to do after that. Again, whether results will play a role or not. Definitely, the in Delhi, I think their sales would have increased a little bit, right? So yeah, but 200-day moving average, very critical support, and if that does not hold, then 3,800 is definitely a level to consider that it really could. Today, gone up, very impressive, and the green candle volumes are decent. They have been picking up very low for some time and then it just cracked. I wonder if there was any event here on this day or something like that. Okay, because 3 weeks it just went sideways, 4.6, 4.6, 4.6, and then just went down to 4.3 in 2 days. That's 10% off. Okay, almost. So potential buy, but again, from a trading perspective, sure, you could go long and put a stop loss below 4100, but and 44 will be a very strong resistance. 45 will be an even stronger resistance at this point. Okay, M&M, wait, M&M, yeah. So M&M also close to its life high. Yep, very much. Okay. Okay, very close to very important support level on M&M, and the way it has come down today is definitely not healthy, right? Very large red candle, right? And I don't know if any results were out or anything like that, but looks like M&M is definitely going further down. I would say 1200 is a good resistance for it in case there is a bounce back up. 1200, give or take 15-20 rupees this side that side, is most likely a good resistance. So if there's a bounce, look at 1200 levels and how that works. But looks like this is going down to 1100 quite nicely, right? Okay, so that is M&M. In the same line, we should look at Bosch. Okay, so okay, okay, so fantastic move by Bosch in the last 5 or 10 years, whichever way you want to calculate it. Now, okay, so Bosch has come to a good support level. This is quite interesting, and this is definitely a company. It's gone from 28,000 to 8,000, so that's what 30-40% off on a large MNC company. And from an automobile perspective, this definitely has a lot of potential left. There's a lot of new technologies that need to come into the automotive sector in the next few years, some of which I'm sure Bosch has, and it's just a matter of time. So whether it's a good place to buy, I would say wait and watch. If 18,100 breaks, then easily up to 18,000 is on the cards as far as Bosch is concerned, and one should be buying it only above 19,100, right? In case there is any buying, it has to be above 19,100. 20,000 is going to be really, really good resistance. Valuations wise, this might actually be presenting a very good uh, opportunity. I'm not sure. I haven't don't have stock specific fundamental data. We do have index data. Okay, so if anybody has any levels on Bosch fundamentally, then do let us know. But if 18,000 breaks, then easily 15,000 I think is on the card. Just pure sentimental reasons, it could just collapse to 15,000. So this is a weekly chart, and see how nicely it is sitting at 18,100. It's like for some reason stuck there, and the next level would really be only I think 15,000. So this could make a lot of money if it goes down, and in a sense this is still okay. Downtrend broken, possible, right? All put together, I think it's still a wait and watch situation. So you've got this week's candles or last week's candle, which is very bearish, the one before that, which is very bullish. In today's is just one day, and it's just still evolving. Okay. Hmm. Could be a buying opportunity. I'd just say wait and watch. Okay. Yeah. Okay. So then let's look at banks quickly. Starting with Axis Bank. Okay, so remember the Bank Nifty was at a particular level, and if we go back to that just to revise quickly, so the Bank Nifty was forming a sort of tweezers bottom. Whether that's hold or not, good point. The macro thing being that you're going to have more and more NPAs and perhaps lower EPSs. And then if you look at the from that perspective, right? So all banks, irrespective of pedigree, private sector or public sector, are definitely bleeding. Important support at around 415 for Axis Bank, and one of the very cardinal rules of Doe theory is assume that the current trend is in place till such time that you have evidence of it not being in place, and that evidence clearly does not exist today. Uh, so interesting volume picture in the last 3 days. Okay, so there's definitely some committed buying, I would say, happening at around 415 levels. If it holds, then around till 430, 440, there's a good upside, but there's an overall downtrend which is there, and it could go up and then easily come down. So no, I would say investment buying, but from a trading perspective, you could buy this with a stop loss at around 404, 405, with the first target around 430 and then 440, 445. On the other hand, should it break down, and that level would be the level to watch out for, 408. If 408, 405 breaks down, then 400 is unlikely to hold, and you could see the price at around 480 to 470 region. Okay, sorry, 360 to, what am I saying? Time to sleep, perhaps 370 region, right? So that will be really a good shot which is there. Okay. Okay, so that is Axis, uh, Bank of Baroda. So if you look at that, came to an important multi-year support level today, and then has managed to just climb back at around 140, 139 levels. But this is a multi-year level we are talking about, and given the the sentiments in the market, quite possibly that this green candle is just a relief rally today, and we are looking at 125 in the as the price in the weeks ahead. So anywhere from, let's say, it could go up to so you have a hammer, but unless there's confirmation, this down move is definitely not over. Unless it goes above 145, 148, I would definitely not be buying it. Much better to wait. 134 is a good stop loss for any long, but if it goes up till even 145 and is not able to go beyond that, then that's a short. And once it's below 135, then this is a price which is going all the way to most probably 125. Okay, so that is Bank of Baroda. Then we look at HDFC Bank. Okay. So you look at HDFC Bank, actually doing quite well in terms of holding on to its gains and not really falling above the 200-day moving average. Also 1043. Well, this is sort of stuff you don't want to be shorting. You never know when bulls come along and decide to buy. So I would definitely say don't short this. Just keep watching it. One thing about HDFC is that on the first time in its life, it has become a 1,000 rupee stock, and then the market is going to have to take. It usually will take some time to get used to the fact this is a 1,000 rupee stock, and once it does that, then it'll set itself up for the next move, which is you never know when it is. So just 1045, 1040. If that breaks, then at least 1020, 1020 is quite possible. But again, we'll keep a event calendar and all. On the other hand, 1040 could be really a good buy with a target of 1080 in the short term. And then once it clears this, okay, once it clears that, then 1120 is clearly something which is on the cards, and 1120 breaks, then 1200, definitely a good one worth looking at on the long side. If you're shorting this, then be careful, could easily turn back very quickly. Rather look at it on the long side. Definitely a bank with fewer NPAs than most of the other ones. Next we look at ICICI Bank, right? And that you can clearly see, just in the quality of the business, clear downtrend on ICICI Bank, right? And barely made a new life high compared to, say, HDFC Bank of the 2008 levels. And clearly you can therefore say that in terms of stock performance and probably many other things, HDFC is the one should be buying, and not really ICICI Bank, right? So broke 250 very clearly, tried to recover today, but really not able to do that. And I would say any move to 250, 252 should be used for shorting, and all the way down to, this could go to, looking at what are the levels, 220, 220, 225, anywhere there is the next immediate level. And if that breaks, then I think in steps of 10, 200, 180, 160 is what you want to be looking at. In terms of something that you could, I think really good support multi-year wise is only at around 150, looks like that. Okay, 150, 160, somewhere in that zone is where any reasonable support is. 100 rupees down from here, well, why not? Remember that in 2009 this went down from 280 levels to 60 levels, right? So I'm not saying this is a situation like that, but there is more and more talk, if you're watching any of the serious commentary, about how we could be in for a bear year this year. Okay, all right. So ICICI Bank, then IndusInd Bank. Whoa, definitely not shorting this at all. This is a stock which is waiting to go above 1000 rupees. Okay, and one day it's going to do that, and you're going to get a rally like you saw in HDFC Bank, and then it'll settle down, and then you'll get another rally. But this is definitely itching to, try and attempt breaking 1000. It has not done that. Uh, Definitely a stock that I would say one should not short, and just sort of watch for potential longs at some point. 880, 890, it's at 930 now, could be a good place to buy. Or once it crosses above 140, first target, life high at around 985, then the next target would be 1000 rupees. So unless something dramatic comes out in terms of results, then it's uh, mostly a buying opportunity. And Prabhakar adds that it's IndusInd tomorrow results are during market hours, right? Okay. Thank you very much for that. So this is something that you should watch tomorrow. If the results are good, just go long on it. And if it is bad, then well, short it. So, even if results are average, the thing that since there's so much, what do you say, negativity around the banking side, and anything that does well in such a market will get rewarded, could definitely be a worthwhile buy. Okay, so good. IndusInd Bank should be on your watch list for tomorrow's trading. Kotak Bank. All right. So Kotak. All right. So that's had a massive run up, right? So it was what in 2009 it was a 50 rupee thing. It is now 700 rupees, and whichever way you look at it, it's been a massive wealth creator. Um, 2008 peak, this was at 350. It's basically double of that today. And so it has bought over ING, and it's integrating ING into its environment. Okay. So you can see trend line being held by Kotak, and quite likely that I think it will find some support and go up. Okay, so what an important support level, trend line support, moving average, long-term support. So this is something else which is looking bullish. Uh, 2015 to now, so 1 year, could be considered to be a period of consolidation for this bank, I would say, in terms of price, right? Because it went up double in the year before that, and for 1 year essentially it has not performed, and this is typical. After a healthy move, consolidation tends to happen. So a doubling of price in 2014 and 2015 was a period of rest, right? Once it breaks out of 745, 750 levels, and that's when the next move is going to happen. On the other hand, even if it comes down to around 650, 640, even 600 for that matter, right? One should consider buying it at lower levels, and definitely not for shorting this at any time in the future, in the near future at least, right? So that is Kotak Bank. Then we've got where is State Bank of India, right? So you can see a dramatically different picture here. SBI is falling like a rock in water. Okay, no support, nothing, and nothing to help it go up. So 200 is what you must wait for. That's the next top on the stock is at 204, and so the low was what today 20265. You got a very important double top at 340. Long way off from there, I know that right now. But 200, and watch how it behaves around 200. In case 200 holds, buy. So this is a stock you should just be waiting and watching, not something that one should be trading. And it is at a support zone. So do nothing with it right now, and then take a view on it as we get more information. But at this point, looks like it's just committed to actually go down. Really, no indication of strength at all. Quite a good one to perhaps short if there's a bounce. Okay, if otherwise, best to ignore it. So just this is a wait and watch stock, right? Okay, then last one, PNB, Punjab National Bank. Well, that's also clearly going down. It's really not showing any strength. But today, small doji, however, sort of a gap down, which is there. I think what you need to watch here is this obvious psychological number of 100 rupees, right? So you need to look at 100 and see how 100 behaves. Could be a place for support, or it could be a place from where it goes down much more. So 100 is a multi-year support from 2007, 8, 13, etc. Right? So could be a place where it decides to settle down. Way too early to say. Right? Okay. Uh, so I don't think we're going to finish all the stocks today. I'm just going to do a few more 10-15 minutes and then we will close. It's already 2.5 hour session. So if there are any particular stocks off the Nifty only that you want covered, be a good time to put that in the chat box and we will do that. So we finished we finished banks and we finished auto. The next big group is pharma. So let's have a look at that, right? So we'll start with Cipla. Okay. So just to recollect, the pharma index going down pretty unhealthy in the way, I mean, the picture of that chart basically, right? Nothing else about it. And you can see that in Cipla, well, it's not been able to really hold on to any support levels. It's just well, you can't say collapsing, but definitely going down. So important multi-month support, I would say, has been broken. And are we looking at a level which is maybe at even at 570? And today's volume was very important. Okay, so it's gone down on high volumes for the last 2 days, trying to find its bottom somewhere long, not long, but a sort of stubby lower shadow. That's why I'm saying that maybe 600, but it looks a little iffy right now. Could, I'm not saying no. So we put 600 here. Okay, so let's wait and watch. So 600. Okay. Here we are at 570. If 600 breaks, 570 is more or less, I would say close to guaranteed. And you can put a stop loss at around 607, 608 if 600 breaks. Till then, you may want to watch. But on the other hand, even if it does go up to about 620, 630, that could also be a good place to short. So that is Cipla. Then Dr. Reddy's. So Dr. Reddy's, lot of gaps, just not being able to recover at all, okay, and broke the 3000 level. Volumes are, can't say high, they have been much higher before, but the way it's broken, we're looking at probably those levels which are at 2530. So 28 first level and then 2530, and well, quite possible that it's coming. This was, I think, when the FDA news came out. This is the big crack, and then it just kept falling. So from 3.6, another 20% fall. Having said that, these are some of the companies which, while we tend to write them off in the short term, they do tend to bounce back at some point in the future. a lot of drugs going to become generic as time goes on, and these definitely be the companies that are going to leverage on that. And then you've got MACD crossover here. That's definitely a healthy sign, and the MACD is at a much higher level than it was. And this is definitely a bullish divergence at this point. Okay, so can't rule that out. Uh, So could we perhaps look at a bounce on Dr. Reddy's? Let's look at Cipla also. No, Cipla doesn't have a bullish divergence, none at all. But Dr. Reddy's does have a bullish divergence. Okay, so that's interesting. Okay, so what do we make of that? Let's review the long-term chart. Okay, so what we make of that is basically that it could perhaps not fall a lot more. And for those of us who trade or like divergences, then instead of shorting it, you want to just keep watching it until it goes lower. And at some point, if the bullish divergence gets stronger, then that will be a good place to buy. Consider the fact that the stock has gone from 4,400 to 3,000. That's like a 25-30% cut, and basically on some news. All right. I don't think any of these FDA things, especially when they're talking about just as a warning letter, and it's not like the drug is banned, it's not like they can't export, it's not like new applications are stopped and all. It's just a very severe market reaction which happens. And then you see the sell off, and then 6 months later, the stock is very clearly back up. So if anybody is a has pharmaceutical industry insight, then please do share your insights here, and who knows, we might actually be looking at a good buying opportunity rather than a shorting opportunity. Okay, then which are the other ones here? Lupin. Okay, so Lupin also not breaking, but at important support levels, and double triple top 1700, looking really dicey. Volumes have come down clearly, right? So looks like pharma might be, I'm just saying might be bottoming out. Okay, so earlier we had a clearly a more bearish view about pharma, but after looking at this, I'm just wondering whether there's a possible bottoming out. This is a 2-year support line we are looking at, and if it breaks that, then next level is 1500, and could be a good fundamental buying opportunity at that level. I think we've run out of Sun Pharma is there. Okay, Tata Motor, sorry, Sun Pharma. I think it was Tata Motors in auto, right? Yeah. So very nice triangle, clearly broke down, textbook type, met measuring implications, and did more. I think it did a window. Yes, yeah, there was a gap here, and that gap was eventually closed. Another big gap here, which was also closed. So clearly at lower levels, this is being bought. Okay, Sun Pharma at lower levels is being bought. There is no doubt about that. and look at, oh, big volume buying at lower levels. So somebody, institutions, promoters, whoever, 1200 to 750, around 700, there seems to be some committed buying which is going on at those lower levels. So I would say definitely don't short this. If it comes down to around 760, 740, could actually be a good buying opportunity. Or even now, once it crosses 800 on good volumes being defined as anything above I would say three and a half, above 4 million, then think about buying it. Be very patient. A lot of resistance at 820, 840, but once it clears that, then you should see much higher and much healthier levels. Right. So this is interesting. So if we first said Sun Pharma is something that we should probably be selling, pharmaceuticals and all. But after seeing this picture, both for Sun Pharma and for Dr. Reddy's, not so much for Lupin, well, things are not looking that bad on the other hand. Okay. Okay. I think we'll stop here. It's 11:30. It's going to get really late, right? So, so if there are any questions or any specific stocks, maybe we can just finish two or three more within the Nifty. I'll be happy to take that. Otherwise, I really hope that you've got a, enjoyed the session today. It's been insightful. Got a sense of what all we are going to do. This new stuff in terms of relative performance. So next time onwards, we're going to look at those sectors more in detail, which are showing some strength. So actually, let's do that. Let's do at least DLF. Right, DLF is however gone. There's nothing in uh, sorry, there's nothing in NSC which has a good representation of reality space. Okay, so this is DLF chart, and 1300 rupees stock in 2008 is now 100 rupees. What a fall, right? And the life low of the stock is somewhere there. Okay, I'll just mark it in red. And from 95 rupees, it's gone to 110. It went all the way to 140, came to 105, and then has been struggling there. You can very clearly see a few things, right? So what are those in this move here? Whenever we went up, the down candles, the red candles are quite small in size, volumes are also low. The green candles are large in size and the volumes are also high. And also this move from 140 here to all the way to almost 100 rupees here happened on overall very low or clearly low volume. So that down move of almost 20-30% was on low volume. Then again, really good volume pickup at lower levels, very significant buying, 30 million shares, 20 million shares, definitely not retail stuff, okay, which is taking the stock up. We took it up from about 100, 103 to 120. Again, it slipped down, and then there was an attempt to move it up again last week from about 115 to 120, but then again it's cracked on high volumes at this point. And then yesterday and today there hasn't been that higher volume, but essentially around that 105 um, uh, to 110 zone or even 100, there's accumulation which is most probably going on, right? And that's something just to be very clear about. And I think this stock is unlikely to break it looks like it's unlikely to break 100 at this point. On the weekly chart, if we look at it, and if you look at this, then clearly, you know, there's a downtrend, but good base for the last since October of last year, that this is not really breaking down off. If you are on the conservative side, and actually even not on the conservative side, if you're just looking at all the global and Chinese risks which are there, then might probably does make some sense to probably just wait and hold on to anything here, and then maybe buy it at a higher level with less risk probably at that time. On the other hand, if you are an aggressive investor, then you could perhaps look at buying it even now. And let's just put this trend line for now and see how it holds. It's not really a good one. Can we date from here? Wow. Okay. Right. So if this trend line holds, and so far it has held, then clearly we've got a tentative higher bottom here, we've got a higher bottom here, then we've got a lower bottom, but on the other hand, this could be a higher top, higher bottom, very, very early stages, I would say, which are forming. And the last part is now looking like a symmetrical triangle. So if we want to look at say measuring implication, you're talking about 140 to 110, $40, and anytime it moves out, if it breaks down from 110, 40 minus makes it go to 70 rupees, which is like wow. uh, don't know whether that will be a fantastic valuation opportunity or what. But on the other hand, if it breaks above 130 plus 40, it's all the way to 170. That's a very, very healthy return. You're talking about you're talking about 30-35% returns, short or long, on the spot valuations, right? So that is something to definitely keep in mind. Where is reality? Right. So these are all the reality ones, and the one that is doing well for the last let's say for the last few months is clearly, hey, this is not real. What is this? Oops, this is totally think mixed up a bit. Okay, some bug somewhere. Okay, this was looking at any other reality stocks. Yeah, so at least I think DLF, that's the bigger one. That's the one you should be watching. Um, Tempted to say it's looking good. Indicators wise, no weakness. Hmm. Okay, definitely an early aggressive buy if you're looking at it. Not, I don't think one should be shorting it. And that's it. Is there any other particular sector we missed? I don't think so. Tata Steel. Let's look at Tata Steel. Ha. So Tata Steel, big, 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 big. So we are at a very important juncture rather, on Tata Steel. 200 good psychological support. It has taken that 200 rupee support, and multi-year level 203, 2089, sort of not really counting, but still 2013, and then now here. Okay, so Question is whether this is just a technical bounce, 200 rupees, and it has really done, gone up after that, or is this a is there more to it, right? So this is the weekly chart, and 200, 250, and yep. Let's look at. I forgotten about this price volume trend. Yep, looking healthy. So you can see that the volumes are supportive of this stock actually going up, and that's definitely a good sign. Just want to check that for DLF also. Okay, DLF not so good. Okay, in terms of the volume picture, but Tata Steel is looking healthy on the volume picture. That's accumulation then that is probably going on the indicators side. Well, clearly this thing has shifted to the plus 50 zone, so that is something to note and keep in mind. Okay, so Tata Steel and DLF, sticking my neck out and saying that they're potential buys. On Tata Steel, if you're buying it, good stop loss is below 235, and you'll have to be patient till it crosses 280. 280 is where the 200-day moving average is, 279 actually, and once it breaks that, that's when you're going to get the next big move. Right now, it's being supported by this trend line. Let's see if we can pull it back. Doesn't really fit very well, does it? Okay. So as long as that doesn't break, for now, that seems fine. But of course, it's all, I would say adjust fit. Let's put that. That's a better one. Yeah, right. So that's what you want to look at. And also, importantly, where is that? The multi-year. So this is from 2014. This downtrend line, right, which is the most extreme downtrend line that I could have put, has actually been broken out. There was an attempted breakout of this last week, and there's been a cool off after that. And then, as long as the support holds, then we could actually see this going much higher. From its lows in July, thereabouts of 200 rupees, it went to 250. That's like, a 20% move up already. And then from there, let's see what it does. And again, that this is actually a very, very important, what I would say, 12, 13-year support line. Doesn't mean it cannot break, but right now looking very unlikely, and technically looking good on all parameters like volume, trend, and breaking one or moving averages one after the other. Actually, this is possibly a correction from, so it's from it went to 275, it's come back to 250. It's given you 10%, 10 20 rupee lower range to actually get in. So this is actually a pleasant surprise, because I was expecting to find a lot of shorting opportunities in the stocks, but actually we seem to have done I don't know, if not 50-50 or 40-60 or 30-70 thing, where I didn't expect to find so many long opportunities. They're both in some pharma, in the metal, in the realty, and the biggest, I think, shortings were all mostly in the banks and some in the autos, right? Okay, done, great. So with that, we're going to stop this session here. I really thank you for your participation. I know it's been much longer than anticipated. I would love to have your feedback. So once we formally close this, I will stay back to take any questions if you have, and if you're not having anything now, please do take some time to send in anything with your email, via an email. And if you need any information about the IMR, then this is the link to go and have a look at. And we look forward to having this on a weekly and a regular basis going forward. If you want to participate in the future IMRs, have a look here and feel free to get in touch on this number with any questions and feedback, right? So thank you, and have a good day tomorrow, this week, and hopefully this helps you make more money in this year. And we're committed to really doing that at a, well, let me just say, at a higher level than we have done in the last few years. Thank you for your support, and I look forward to your continued participation in the weeks, months, and years ahead. Thank you, and good night.